Hello and welcome to the France 24 interview. Our guest today is Jan Randolph, who's the Director of Sovereign Risk at IHS Global Insight. He joins us via satellite from London. Mr. Randolph, thank you for being on the show.
Pleasure to be with you.
So last Friday, Standard & Poor's, the credit rating agency, downgraded 9 European countries, including France, which lost its much cherished AAA rating. On Monday, one of the competitors of Standard & Poor's, Moody's, said it would not downgrade France. And also on Monday, France was able to raise 8.5 billion euros on the markets at a lower rate despite the downgrade. What's your reaction to the fact that France was able to raise money at a lower rate despite the Standard & Poor's verdict?
Well, it's very interesting because we normally assume that a country that has a lower credit rating has to pay more interest for the higher risk. But we've had this ironic situation where France is paying lower than last week despite the downgrade. It's a very similar pattern to what happened the middle of last year with the US, when the US AAA rating was downgraded also to AA+, and subsequently its borrowing costs actually fell. What's really more important at the end of the day are the borrowing costs, because it's the bond markets and what they rate implicitly when they lend is much more important. Borrowing costs have the ability to bite public finances. Credit ratings are private credit opinions, and they can diverge. They're not always the same. I think all of us in the rating business look at the same raw material, the politics, the finances, the economy, but sometimes we have different methodologies. And Standard & Poor's has been more aggressive, I think, than others.
Do you think the markets are reacting the way they did today because they had anticipated that France could not hold to its AAA with all the major rating agencies?
Yeah, I think they've taken it in their stride. The news about the downgrade was marked well in advance, the possibility of that. And quite frankly, market participants also do their own assessments. So this is not a surprise, and that's the main thing. And that's why the market reaction, both in terms of the capital markets, the bond markets, and also the stock markets, was relatively muted. I think also we have to take into account that today America is on holiday. But even so, I think the more important news has been what the European Central Bank has been doing over the last few weeks by offering 3-year loans, unlimited 3-year loans at 1%. That really has brought down borrowing costs even for the so-called riskier countries like Italy and Spain, particularly at the short end. That's maturities of less than 3 years. And really that was more important material significance than the credit rating opinion of Standard & Poor's.
Do you think that there will be further downgrades for France, either by Standard & Poor's or other rating agencies? Do you see this as just the beginning?
Well, it's an interesting one because in some sense the analysis, if you look at examine the analysis behind the downgrade, Standard & Poor's said the problems lie more with the Eurozone itself than the individual countries. And in particular, they talked about the systemic problems and the inability of Eurozone institutions to deal with the systemic situation. And what they really mean here is, unlike the US, UK, Denmark, where they had their own central bank and they could always pull out their central bank to print money to pay off 10-year bond investors, that's not necessarily the case with Eurozone governments. And because of that, long-term investors are pricing in that risk. But it's also seen as a problem by Standard & Poor's. Obviously, the Eurozone wants to get together its fiscal compact, its debt rules, much more cohesively. And I think on that basis, if that is delivered, I think the European Central Bank can act more aggressively and start to resolve the situation much more comprehensively.
So since your business is assessing risk, if you had to bet, would you think that France will have further downgrades in the months to come before the situation hopefully comes under control?
I think it's quite possible. I mean, they're kept on negative outlook. But quite frankly, what does it actually mean? It's like being in top of the class of 20 and suddenly you find yourself number 17 or 18 in the class. It's still very good. It's just that you're not top in the class anymore. And that's what it's like to move down one or two rungs from AAA. It's not cataclysmic. And as we've seen, it may even not affect your borrowing costs. Other factors come into play here. And I suggested the more aggressive policies of the European Central Bank in providing unlimited liquidity, 1% over 3 years, has been much, much more important in affecting those borrowing costs than the rating movements.
I want to get back to what Standard & Poor's said on Friday. 9 European countries were concerned. There was a rather comprehensive analysis of the situation in Europe, and the agency also criticized all the austerity measures, saying austerity is necessary, it's good, but it's far from enough.
Yes, I mean, it's an interesting one. It's absolutely centre to the big debates between economists and credit risk analysts. Now, quite honestly, a lot of these governments have no choice, given some of the market pressures on refinancing costs like Greece, Ireland and Portugal. They had no choice but to adopt austerity and to get a grip on their finances. Others, for example, the UK and US, believe they've got more time. Well, certainly the US does. The UK has adopted austerity. But it is true, austerity can be self-defeating. The tighter your budget means that you're going to lose growth, and those debt ratios needn't necessarily improve. It really depends on how robust and how competitive your economy is. I think ideally what needs to happen is an understanding, and I think this is growing in Europe, particularly it needs to be understood by Germany, that austerity by itself is not a solution. There has to be some sort of growth strategy that comes through from in addition to the fiscal austerity, that runs in parallel, so that the economy is leaner and fitter when it emerges from the austerity and is able to raise its growth potential. These are just as important. We call them structural reforms. It could be loosening up the economy, doing some smart, sensible deregulation, opening up the economy, closing down on closed shops and similar trade practices. These things are very important to ignite new sources of growth. And it's very important to have these measures as well as austerity.
In France, there's a lot of debate since the downgrade has been in the air for weeks about whether the opposition socialists who are ahead in the polls have a program that will allow France to keep the markets happy. I mean, do you think that there is a lot of concerns on the markets about what the socialists would do once in power, or do you feel the socialists have sent messages that they would be responsible and keep debt and deficits under control?
I think there wouldn't really be that much difference between the two parties. They may say there's differences, but in practice, I think markets would view them as pretty similar. I think the more important point about borrowing costs, as far as borrowing costs are concerned, is that virtually every Eurozone government now is paying more than Germany. But many of them are still faced with very low borrowing costs. Even France is still paying less than it did a year ago. So it's the absolute level of the borrowing costs. It's true that there's a risk spread, a higher rate of interest being charged now for all Eurozone governments over Germany's. But that's simply a reversal, a partial reversal of what happened in the early 5 years of the Eurozone when borrowing costs started to converge down onto the lowest German rates. We're seeing a partial reversal of that, and the sovereign ratings are also following that pattern.
I want to get to the issue of Greece that's been coming back regularly to the fore. There are supposed to be negotiations this week between the Greek government, private investors, to make sure the deal that was reached several weeks ago is implemented. How much of a concern is it for you?
This is so much more important than Standard & Poor's ratings downgrades. The real live possibility of a disorderly default, in other words, where there's no agreement between the private creditors, how much they were prepared to accept in effective losses, and how much the official sector, the IMF and the Eurozone governments, are going to contribute. If that breaks down, we enter a disorderly default scenario. It could potentially triggers a whole range of credit risk derivatives, which will lead to more contagion, more turmoil. So it's very important that we have an agreement, and the pressure is on. But we do tend to get these high noon moments, and it's a bit like playing poker. But I think with more pressure, they will eventually have to come to agreement, because it's in everyone's best interests that there is an agreement rather than a disorderly default.
And what if there is no agreement? What does that mean?
If there's no agreement, then the IMF has made it absolutely clear that it will only lend into the new financing arrangements if Greece's debt is sustainable. It's mentioned it's got to be about 120% of GDP over the next 5 to 10 years. That's a sustainable level. If there's a shortfall in the private sector haircut, then the IMF will look to the Eurozone governments to make up any difference. That's the arrangement. That's the game that is currently being played.
Jan Randolph, thank you very much for sharing your wisdom on the stormy economic waters here in Europe, in France, in Greece, and elsewhere on the continent. Thank you very much for watching this interview here on France 24.